Hello, everyone, and welcome to another episode of the A&H Berts Stockpickers Podcast with Albert and Hubert.
Here, each week, you can join us in discussing our favourite stocks where we can help you find your next investment opportunity.
We aim to present and discuss the investment thesis for our top picks.
Let's get right into this week's choice. This week, I'll be taking the hot seat with my pick, and that is the global mining company Anglo American plc, a company which I believe can provide a huge amount of value for investors. For anybody who doesn't know about Anglo American, they are a multinational mining corporation with a diversified portfolio of different resources. Some of their main revenue generating resources are diamond, copper, platinum group metals, and iron ore. They have operations in numerous countries from Canada to Brazil to South Africa and Australia. The company is currently trading at 2,600 USD. So my first reason for investing in this company are its improving ESG credentials. ESG credentials will ensure that future investment from financial institutions remain strong as more investors become more focused on ESG. Through embracing this, capital can continue to flow to this company and ensure that they can find investment. So one example of their work to become more ESG compliant is demerging from Thungela Resources, which own several large thermal coal assets, resulting in thermal coal assets making up only around 1% of the company's estimated 2021 EBITDA. They've taken other measures to clean up their operations. So, for example, they have partnered up with Energy to develop large hydrogen-powered trucks to use in their operations instead of the current diesel ones, and are looking at other ways to optimize energy use in their processes. This can ensure that their carbon costs remain low, as countries in the EU especially may start to make this much more expensive, which would give Anglo American a competitive edge.
So, on the top, so going off of that, in terms of, comparative to the industry and competitors, what are we looking at? I mean, looking at the last earnings call for Anglo American, we can obviously see this is something they're quite proud of. There is an entire section on their ESG improvement, which is really good. And remember, we have to bear in mind, it's not even just the environment. We have the sort of the safety, the hiring policies and all that. So, I mean, in terms of safety, their safety is pretty staggering to see the improvements. Since 2016, we've basically gone to nearly zero, fatalities, which, is what we want. And even sort of small injuries have gone down significantly. The same goes for health. So this might put mining in a better light. And yeah, the only thing I would say is the greenhouse emissions currently are they going down slowly, but is slow and steady. Do you think this, decline in greenhouse emissions at the rate it's going is enough to capture some of the more hardcore ESG investors?
Yeah, I think, well, one thing you have to consider with this is that the industry in question, I mean, it's mining. So, for example, in the smelting process, there is inevitably a huge amount of energy use. And to an extent, this is something which is a very energy intensive. And it's not going to be able to compete with a lot of other companies in terms of emissions alone. But I think you have to consider it relative to its competitors. And relative to its competitors, this company is doing very well, and it's allowing it to gain a competitive edge over the others. I mean, I don't think that it'll ever be considered, it'll ever be on a pedestal in the green industries, but I think it could become much more in line with what investors are looking for.
So, in terms of sort of even a top-down sort of view of ESG, I know when we were discussing the stock earlier, you did mention that you think one of the long-term drivers of growth for this actually will be the element of sort of external ESG, electric vehicles and so forth, especially, given they need some of the, quite heavily need some of the resources that Anglo American produces. Is this something that sort of further pushes your case?
Yeah, I think so. And that was kind of my next point. So a good example, I think, are electric vehicles, which are becoming more widespread. So two elements which are critical in the manufacturing process: copper and nickel. Anglo American, is huge producers of these materials. So if countries and indeed companies are pushing more electric vehicles, that is going to help Anglo Americans' revenue streams in those areas, pushing up the prices in these markets. I think you have to consider the time frame we're talking about here, though. This is probably not going to be the next couple of years. So far, take up of electric vehicles is very slow, for example, and looking to the future, this will take time, but most likely, even if it's slow, these will make progress, and these materials will always be in high demand, which will of course help Anglo American's revenue. I think also politically, especially in Europe, but also in the United States and possibly further afield, a lot of governments are seeking to increase their investment in green technologies, sort of post-COVID stimulus. A lot of it will probably go to green technologies. Again, this will help supply a lot of demand for the materials that Anglo American provides, and this is long term, but it's not unforeseeable. It could be in the next few years we can start to see this taking effect.
And sort of one final sort of point on ESG, you did mention carbon costs. I mean, carbon prices currently, sit in sort of the mid double digits, but across the sort of the street, we have noticed, a lot of firms are increasing, their price targets on carbon, potentially reaching somewhere double what it is now in the next year or so. No one's really sure exactly how high it's going to go, but there is a thought that it is going to go quite high. Do you think, given, the fact that Anglo American has a far better position in terms of ESG and emissions than its competitors, this actually puts it in a great stead to sort of hit these increased costs head on? Do you think this could even increase its competitive position in the long run?
I think absolutely it could. I think that that among its competitors, Anglo American is the best place to weather this, so to speak. They, in terms of carbon costs, they will have uniquely low carbon costs in this sector, which will of course give them a huge competitive edge over its competitors like Rio Tinto and the others. So I think that the carbon costs will in the long term help Anglo American, especially as they continue to push their ESG goals. So I'm going to go on to my next point, which are its diversified holdings compared to its competitors. So Anglo American's revenue is divided among a huge number of different resources, including copper, PGMs, iron ore, coal, and diamonds. This is in comparison to other mining companies such as Rio Tinto and BHP. For example, Rio Tinto, 73% of its revenue comes from iron ore, and BHP is similar, 70% of iron ore. Anglo American has an edge in this, as they are not affected by a weakness in one particular commodity. This was seen this year, actually, when iron ore prices fell significantly from 219 in July to 133 in September, where it really hit the revenues of Rio Tinto and BHP. However, in the case of Anglo American, a weakness in one particular resource, such as iron ore, can be picked up in demand for other resources. Through mixing these different commodities, this makes Anglo American a much better defensive stock than its competitors in mining.
Yeah, I mean, that's a very fair point you make, because, I mean, looking at the last earnings sort of announcement, the company did really, really well. I mean, it had sort of record levels of sort of EBITDA and EBITDA margins, and the EBITDA margin's gone up to 61% according to the corporates, which is fantastic. Even given these potential sort of falls in iron ore prices and so on, going across the board. But the real question here is a big holding, a big position of Anglo American is actually the Chinese market, which Asia accounts for 70% roughly of the presence of Anglo American, with China accounting for 30% of that. This is quite a big sector of the market, and how much do you think the Chinese market, and especially recently, the last Bloomberg report shows that the Chinese indices and indicators for this for this area, might be slightly shaky. How do you see this being a thing in the long run? Will this have an effect despite its diversified position?
Well, it's true that across the board, the commodity markets have looked significantly weaker in the last few months. A lot of this is due to the crackdown by the Chinese government on commodity speculation, because they were concerned about this behavior eroding the profits of many of their firms. Um, and yes, I think that in the short term, this will hit profits. It has weakened commodity markets, and yes, I think for Anglo American in the short term, this will have an effect. Looking forward, though, it is a question of will the growth in China and other Asian countries continue, which it most likely will, and again, other countries, the United States and Europe, can help to pick up demand that may have fallen from China. For example, as I mentioned before, the possibility of Green New Deals, policies like that in the US and in Europe could ensure that demand for Anglo American's resources will remain strong in the longer term. But yes, I agree that this, in the short term, certainly that this may pose an issue. So I'm going to just go on to my final point, which is the value of the company's shares. So the company is currently trading on a 6.3% P ratio, which indicates that the shares are not overvalued relative to the company's performance. The company also offers attractive dividend yields of 6.7%, which is a sustainable level for the company with a dividend cover of 1.97. As well as offering its strong dividends, the company also has significant growth potential, with the consensus stock price right now being $3,373 per share, according to the analyst consensus target price. So I think that buying into the stock now will offer the strong possibility for growth as well as strong dividend yields.
Yeah, I mean, just sort of tying in the two last points together, sorry to cut in, but do we think perhaps that recent, potential blip in China actually provides a slight buying opportunity now for the stock?
Oh, I think absolutely it does. I mean, it has, the share price has tumbled significantly. I believe it's at around $2,600 right now, which was a significant drop. And so I think that absolutely this is a really good time to buy in the share now. It has recovered somewhat, but nowhere near its previous levels. So I think that absolutely now is a good time to buy it, with the news from China still currently weighing in on investors' minds.
And yeah, given the fact that some of its competitors like Rio Tinto appear to have marginally sort of cheaper looking stocks, this could look a little strange in terms of pitching a value stock. But if we compare sort of Anglo American to its competitors, the fact it's in a far better position to deal with the long term sort of cost hits of rising carbon prices. It's got a far better cost model already, far below its competitors, and its diversified position, like you said, put it in in terms of long term sustainability. This does actually look like a pretty good value stock. I mean, it's got pretty high free cash flow yields as well. And one could argue that the entire mining industry in itself is a value industry, and there's lots of speculation across the street about value potentially having its day in the sunshine once again after growth performing so well for so long. Now people are turning more to value potentially. Do you think that could be a potential success of Anglo as well?
I think that definitely, on your first point there, I think that yes, there's, according to some valuations, you could say that Rio Tinto is a better value buy. I would say that I think Anglo American is simply a much better company, especially in terms of its ESG, in terms of the way the company is run. And also, as I said before, its diversified portfolio, which again means it's much less vulnerable to huge swings. And yeah, its FCF yield is extremely strong at 11.9, and also its EV a bit 4.5. looking longer term with uniquely low costs. Out of its competitors, I would say that Anglo American is long term best poised for future success and for retaining its value, well into the future. I mean, this is not a high growth stock. It's definitely a value buy, and I think that certainly we can see that it has a lot of value for investors.
And so I mean, I think all those points, sort of suggest a very decent long-term investment with a potential, income play as well with that high dividend yield, and a potential value play. Then I'm just going to throw in a final thing that I think this company could have in terms of a short term. No, given that one of its sort of holdings, is the De Beers market for rough diamonds. I'm only speculating here. This is your stock, not mine. But I think potentially there's a COVID play here as well. I mean, firstly, whole company wise, it's only been operating at 95% capacity and has displayed record-breaking results in the last earnings, because of COVID, and they hope to sort of scale that up again. So that could be a nice short-term little play there. But bigger wise, I think the diamond market, COVID recovery, a lot more people potentially who would have proposed before are not now going to start proposing. Potentially we could see an increased demand for the diamond. For diamonds, rough diamonds could go up in price. That's a potential. I mean, let me know your thoughts on that.
Yeah, I mean, I think that certainly there could be a lot of pent up demand for things like diamonds. And just to provide some context, diamonds do make up 6% of the company's EBITDA. So if there is a rise in demand for these diamonds, then I think certainly the company will benefit from it. I think this one comes down to sort of consumer behavior, which is a lot of people as a result of COVID are concerned about spending too much on consumables. But having said that, diamonds do tend to hold their value. So consumers post-COVID, this is something which they might definitely be willing to spend their money on, which would certainly benefit Anglo American. So yeah, I think that is a possibility, and I think that could, in its diamond operations, have an effect.
Awesome. I think before we wrap up, if we do a quick summary of the points.
Sure. So the three main reasons I feel you should invest in Anglo American are that it's a diversified holding which provides a strong defensive stock that is not reliant on a single commodity or predominantly reliant on a single commodity. Secondly, in terms of its ESG, it is a leader in the industry, which will ensure that it can continue to attract investment and can expand its operations as a result. I think it will also be poised to benefit in the long term from an increased green movement from many governments who are seeking to invest post-COVID. Thirdly, I think that it is extremely good in terms of its value, with a low PE ratio, strong financials, and provides a good dividend yield. And because of these, I think that it stands out in the mining industry and is definitely worth spotting your portfolio.
Amazing. I mean, with that, I think we're going to wrap up today's episode, and we look forward to you guys joining us next week. We hope you enjoyed this week's discussion. Let us know what you thought on this week's pick. Let us know in the comments on our social media. Do pop up on LinkedIn. It'd be really nice to get some engagement as well.
If you have any suggestions of stocks you think we should cover, then please let us know.
And we look forward to seeing you for another episode next week. Remember, it's going to be coming out 4 p.m. on YouTube and on Spotify for now, potentially on Apple Podcasts very soon. Thank you very much.